Good afternoon and welcome to today's presentation. Everything you always wanted to know about calculating economic damages, but were afraid to ask. The information presented by the expert is not to be used as legal advice and does not indicate a working relationship with the expert. All materials obtained from this presentation are merely for educational purposes and should not be used in a court of law. In today's webinar, Nora will discuss calculating present value, growth rates, and prejudgment interest, determining the duration of economic loss, work-life, life and healthy life expectancies, determining wage loss, earning history, earning capacity, self-employed workers, all about fringe benefits, earnings in retirement, pensions, Social Security, survivor benefits, equity compensation, restricted stock units, stock options, stock shares, privately held or pre-IPO companies, incorporating taxes, after-tax earnings, tax neutralization calculations, atypical plaintiffs, children, elderly, unemployed, self-employed, practice pointers. Nora Ostrofe has served as a forensic economist for the past 21 years. She has a bachelor's degree in economics from the University of California, Los Angeles, UCLA, an MBA from St. Mary's College, and a certificate in accounting with distinction from the University of California, Berkeley. She has served as president and of the American Rehabilitation Economics Association and is a co-editor of the journal The Earning Analyst. Attendees who require a passcode, the word for today is afraid. During the Q&A session, we ask that you enter this passcode into the Q&A widget for CLE reporting purposes. The Q&A is located to the left of your screen. Please remember that if you are applying for CLE credit, you must log on to your computer as yourself and stay for the full 60 minutes. You are also required to complete the survey at the end of the program. Please note that CLE credit cannot be given to those watching together on a single computer. Tomorrow morning, I will send out an email with a link to the archive recording of the webinar. The slides can be downloaded from the resource list at the widget at the bottom of your screen. Thank you all for attending today. And Nora, the presentation is now turned over to you.
Okay, Nadia, this is a 1 hour presentation or a 1.5 hour presentation?
It's a 1 hour.
It's 1 hour, okay.
Yes.
Okay, and I don't seem to have control over the slides.
You don't?
No.
You can't click, okay. I'll click it.
Yeah, I can't advance the slides.
You can't, someone is advancing the slides.
Okay, well, my screen only is on live view on slide 3. That's all that I can see.
Interesting. So what slide are you on? Slide, what, 9? Which is the, can you see this?
It's not.
Can you see your title page?
No, not on my main screen, no.
You can't see your title page?
Nope.
It's really bizarre because the slides.
Okay, that's okay.
Go ahead.
Yeah, they're not advancing for me. You know what? I'm going to log out and log back in really fast. Can I do that?
Okay. Sure.
Okay.
Apologies for the technical difficulties.
That's okay. It's always something.
I know.
Okay, and I'm going to go in as presenter, correct?
Yes, ma'am.
Okay. Okay. There we go. Okay. All right.
Oh, you got it.
So
Okay.
sorry about that.
Sorry.
Thanks for hanging with us. Okay. I've taught webinars for TASA before, but this is one that I've always wanted to teach, and that is, instead of just sort of addressing some of these topics on the surface, to really dive in and explain to attorneys what economists are doing. I chose this picture for my webinar because this is really how I think my clients really feel when I start to open my mouth, whether I'm in a deposition and talking to opposing counsel or talking to the client who retained me, is that they really don't understand what I'm talking about, but they're afraid to betray that. And so as a result, they end up probably not asking the questions that would really help them understand what I'm doing for their client, or not really understanding what I'm saying in deposition testimony and under cross-examination. So what I'm going to try to give you guys is a sense of what the economist is really doing to give you the confidence to get rid of the fear about the math and the numbers, and also ask the questions that are really going to advance your case. Okay. So one of the concepts that I find people don't really understand is what economists are doing when they're reducing damages to present value. And this is probably going to be the most math-intensive part of my presentation, so just hang with me. The rest is not mathy, but we do need to go address a little bit of math in order to understand this concept. So when we're talking about present value, what we're talking about is the value today about some money that's going to be paid out in the future. And in the context of litigation, we're usually talking about future damages, that is, losses that the plaintiff is going to experience after the date of the trial. Now, whenever we're doing a calculation of present value, we're interested in three factors, okay? We're talking about an amount of money, usually an amount of money per year, like the amount of wages that somebody would earn in a year, or the amount of Social Security benefits they would earn in a year, over a period of time at an interest or discount rate. And the interest rates are usually what U.S. Treasury bonds are paying over a particular period of time. Okay? So let's say I could walk into a bank today and open a savings account and earn 10% interest per year on money that I deposited in my savings account. You're not going to get 10% interest anywhere today, but that's a number that I'm using because it's mathematically easy to use. So let's say I deposit $100, and 1 year from today, I go back into the bank and I take out the $100 I deposited, and I also earned interest. I earned 10% interest over 1 year on the amount of $100. So 10% of $100 is $10, so I withdraw $110, the $100 I originally deposited and the $10 in interest. So what we say in present value terms is the present value of the $110 that I withdraw at the end of the year today is $100, okay? And the future value is $110, okay? And those are both in the context of a period of time that's 1 year and an interest rate of 10%, okay? All right. Now, the reason why we're reducing future losses to present value is because the plaintiff can do just that. In other words, they're receiving all this income that they would have received in the future today in terms of an award, and they can go and invest that award and earn a return on it, just like I earned a return on the $100 in the example I just gave you. And so we don't want to overcompensate them or give them a windfall by paying them too much money. So what we're going to do is we're going to take account of the fact that they can earn a return on their award, and we're going to discount the amount of money that they receive in the award a little bit in order to account for the fact that they can invest the money. All right? So let's say a plaintiff was injured in an auto accident and would have earned $10,000 a year over the next 2 years. Okay, and we say, okay, you would have gotten $10,000 the first year, $10,000 the second year, so we're going to give you a judgment of $20,000 today. And she deposits that in the bank. Okay, and then the first year she earns 10% on the $10,000 that she received in an award to compensate her for lost income this year, so she gets another $1,000. And next year she's going to receive 10% interest on the $10,000 she received for her lost income, and so she would get $1,100. So overall, if we gave her exactly what she lost, okay, without reducing the present value today, she'd receive $3,100 in interest on her award of $20,000. And that would be overcompensating her. So that's why we don't just give plaintiffs exactly what they lost. We account for the time value of money when we're calculating the award, and we're reducing it a little bit to account for the returns that they could get once they invest that award to cover their future losses. Okay, so there it is visually. This is sometimes easier for people to say. There's the $10,000 award. In 1 year it will have grown to cover for her loss for year one, and that's where it would have grown to $11,000 because she would have received 10% or $1,000 in interest. For the $10,000 to cover her for her second year, if she invested it at 10% a year, she'd receive $2,100. Obviously, we don't want to do that. That's a windfall to the plaintiff. We just want her to have $10,000 for each year in the future to cover her future losses. Okay? So knowing that, we're going to give her a little bit less than the $10,000. We're going to discount it by the amount of interest she can earn, or 10%. And so we're going to, instead of giving her $10,000, the $10,000 for her damages for year one, we're going to discount it by 10%. We're going to divide by 1 plus the interest rate and give her $9,090. Okay? At the end of year one, that's going to be exactly what she lost, or the $10,000. So she receives exactly the money she's owed at the time that it's owed to her. Okay? For the second year, okay, to cover that loss, we're going to give her $8,264 because if we invest that at 10%, it'll be worth $9,090 in 1 year and $10,000 in 2 years. Okay? So if we're putting this all together, we're going to discount future annual wages of $10,000 per year over the next 5 years at a 10% interest rate. And you'll notice as we go out in time, the amount we're paying as an award gets smaller and smaller and smaller. So that for the $10,000 that we're going to be paying in damages for her 5th year of loss, we only have to pay her $6,200 because when we give it to her at the date of judgment, she's got 5 years at an interest rate to increase that $6,200 so that it'll be worth $10,000 when it's due in year 5. Okay, so here's a little graph. So there's the $10,000 for year 1, year 2, year 3, year 4, year 5, and you'll notice that each year we're discounting by 10%. Okay, and we're giving somebody a little bit less money. So that she can invest it and earn those returns. Now, if discounting wages to present value wasn't complicated enough, what we haven't factored in is wage growth. In other words, most people may get a cost of living increase or a raise in pay every year. And so let's say we take an example of somebody who earns $100,000 a year and receives annual wage increases of 2%, your future growth of wages is going to look something like this. Okay, in year 1, you get a raise of 2% and you receive $102,000. In year 2, you get a 2% increase on $102,000 and you receive $104,000 and so forth. So that by your 5th year, if you're receiving 2% increases every year, you're making about $110,000 a year. Okay. So here we are growing the wages by 2% a year to account for annual wage increases. All right. But now we've got to discount those back to present value. So not only do we have to build in the wage increases, we have to discount them back to present value. I'm going to use a 3% discount rate here, and so I'm going to grow the 100,000 times 1.02 for the 2% increase. So in year 1, the plaintiff receives $102,000. Then I'm going to discount that by 3%, and I get to a present value of $99,029, right? And so forth all the way out to year 5. So if we have 5 years of wage loss, even though the person has lost, okay, $500,000 a year, and we're growing it at 2%, we're only going to pay them $485,000. Okay? So there we're growing the wages, there we're discounting them to present value. Okay, and that's a lot of math. So is there an easier way? Yes, there's something called a net discount rate, where we're just going to use one rate to both grow and discount wages. And what we do is we take the discount rate and we divide it by the growth rate, or we can subtract it. So we take the discount rate, we subtract the growth rate, and we get a net discount rate. That's why we call it a net discount rate of 1%. So now, instead of growing the wages at 2% a year and discounting them at 3% a year, we can just take the flat wages of $100,000 a year and discount them at 1% and get to the same number. If we do all that, we get back to our $485,000 figure fairly easily. So sometimes when you're looking at, so here we have, instead of growing it, we're just going to keep the wages flat, and we're going to be growing it and discounting it at the same time by using one discount rate. So sometimes if you look at an analysis and you just see, and somebody goes, well, where are my wages? What the economist is probably doing is using one rate to both grow and discount the wages, and that's why you don't visually see the wages growing and then discounting. Okay, so one of the things that you want to ask in analyses is what rate has the person used to grow the wages, and is that commensurate with the kinds of earnings increases the plaintiff would realistically get? And you also want to ask the economists what they've used for a discount rate. Because of COVID right now, the Federal Reserve has made interest rates close to almost zero. So there's very little reduction for discount rates in analyses right now. In fact, probably sometimes the present value is a little higher just because all we're doing is giving people wage increases, but reducing it to present value, we don't have very high rates of return to use. Okay, I'm going to look at questions here. Okay.
Before we get into the question, code into the Q&A widget, please. There is a question.
Okay, I have a comment too. I do. I have a comment. The problem is she's spending the money you give her today, so she has less to earn interest on. That's somewhat true. Some plaintiffs do take their award and just spend it and do not retain it and pay it out at the rate that they would have. Let's say they receive an award of $500,000 for future lost wages of $100,000 a year. But there are firms, I've seen them at attorney conferences, that will work to counsel plaintiffs to put their money in safe investments or to buy an annuity that will pay them out measured damages of their award, but in a measured way every year and so forth. So there's a way to keep plaintiffs from sort of going out and spending their entire award instead of necessarily using it in terms of life care plans on costs that expenses that they will have coming up. Is the discount rate published? Where do I find it? Yes. You can type in Treasury constant maturity rates for different instruments, and that will take you to the Federal Reserve Bank of St. Louis. And they have daily charts that will tell you what interest rates are, but most of them are below 1% right now. Okay, what about promotions? How do I count for wage increases due to promotions in the future? I have that in a different section of my slides. If if there is a documented promotion, I will just try and research what the job that the plaintiff would have been promoted to is worth, and then I'll just build that into my future losses. Usually I want to have evidence of that. For instance, the supervisor would say so, or there's some documentation that most people, if they spend a certain amount of time in this job, would naturally advance to the next job. You don't want to just sort of start speculating as to what somebody's career path would be. Is using my lump sum settlement to buy an annuity worth it, or can the person do better by investing a lump sum himself? It's going to depend on the investment, the sophistication of the plaintiff as to whether they can, manage an investment portfolio better than a professional would. Sometimes annuities are expensive, but frequently purchasing an annuity can be cheaper for the defendant than paying out a sum, because companies that offer annuities don't have to use risk-free investments such as treasuries in order to invest the sums. So sometimes buying an annuity can be cheaper for the defendant, and then the annuity will be guaranteed so that you can be assured that the payout is going to occur. How are forecasts for significant inflation or even slightly accelerated inflation factored in? The Federal Reserve does have an instrument called TIPS that are inflation indexed returns that account for inflation, or the economist can also forecast inflation as well. And there's the Congressional Budget Office will provide forecasts for inflation. Social Security administration has forecasts for inflation, so that data is out there. Okay, I'm going to move on. Okay, now I'm going to talk about work life, and healthy life expectancy. Okay, so what do we mean? And these are measures when the economist is trying to project how long is somebody going to work before they retire, or how long is somebody going to live, or how long is somebody expected to perform household services. We go to life expectancy tables. And I find that these are not well understood by attorneys either. In fact, I was having a conversation with an attorney the other day, and we were talking about a particular plaintiff, and he said, well, he's going to die when he's 76. And I said, well, no. I said, he's in his 70s already. He's probably got a longer life expectancy than that. And he said, but I thought life expectancy in America is age 76, and that's true. But the longer you live, the longer you're expected to live. So these work life expectancies, life expectancies, and healthy life expectancies are always kind of moving targets depending on what age the plaintiff is you're talking about. So let me explain how this works, because I don't think it's something that's well understood. Okay, so when we use the term of life expectancy, what we mean is the expectation of life at any given age. Okay, so life expectancy is going to be different depending on the age of the plaintiff. It's not going to be 76 or whatever the average life expectancy is in the United States for everyone. And it's the average number of years remaining to be lived by those surviving to that age. Let's look at that a little bit more closely. Okay? So for a male who is newly born in the United States, life expectancy is indeed 76.1 years. Okay? But if you're a male and you've survived to age 100, you still have a life expectancy of 2 years. Okay? So how is that? Okay, this is because at every age we're looking at the probability of future survival for those who have already survived to that age. Okay, so when we're looking at life expectancy table, they begin with a sample group of people that they call a cohort, and they track that person, and they track the number of people who survive to each successive year, and then track how much longer they're expected to survive. Okay. So here, we're looking at life expectancy of an infant between age 0 to 1, and you'll notice where it says number surviving to age X, we start out with 100,000 male infants, okay? And over their first year, 578 of them do not survive. Okay, but the remaining, but together that sample group of 100,000 lives 7,860,752 years. So we divide that by the number of the cohort, and we get to age 78.6. So we say that the expectation, this is for the total population, I'm sorry, not males. Okay, so we say that overall, okay, the expectation of life in the United States for an infant age 0 to 1, and this doesn't differentiate by age or gender, is 78.6. Okay? Now, let's look at somebody between the ages of 99 to 100. You'll notice that the number of people from the original group of 100,000, the number of people who survived to this age are only about 2,700. And between the ages of 99 to 100, about 880 people don't survive. Nevertheless, of the 2,700 who survived to age 99, okay, they still have remaining amongst them. They survive about 6,500 years, and so we divide that by the number of people in the cohort, and we get to an average life expectancy of 2.3 years. So if you have an elderly plaintiff and you're looking and they're still working and you're wondering how much longer they will survive and how much longer they will work, it's usually always, no matter how old they are, it's usually a couple of years, and you may have some losses there. Okay? So life expectancy tables are like a game of Survivor. The longer you survive, the longer you're expected to survive. Okay? Work-life expectancy. Okay, work-life expectancy is the number of years a worker would be expected to be active in the workforce. And so they would either be working and earning income, or they would be actively looking for work. Work-life expectancy tables are generally organized by gender, okay, male and female, and then level of education. So they'll start off with less than high school graduate, associate degree, some college, bachelor's degree, master's degree, and then a PhD or professional degree. Okay, and work-life expectancy is going to be used to determine the number of years into the future that a worker would be expected to have earnings. Okay, work-life expectancy is always going to be based on a statistical average. So an individual worker might work more or fewer years than his or her work-life expectancy, but it would be less probable than she or he would do so. But a worker might have good reason to work fewer years, or due to business conditions, or the need to care for family members, or beyond his work-life expectancy, if he or she had to support children in college, or they didn't have the financial ability to retire, or they needed to support other family members. So when I'm doing an analysis, I will always calculate the work-life expectancy. I'll say it's a statistical average, and then I might give the reasons why the plaintiff might have worked fewer years or worked more years, depending on the plaintiff's individual circumstances. Okay. Generally speaking, though, women tend to have a lower work-life expectancy than men, and that's because when they're measuring women in general, there's a significant number of women who do take time to go out of the workforce to care for family members. So if you have a plaintiff who's, let's say, a career woman, no children, no dependents, some economists will use a male work-life expectancy table because they don't want to penalize the woman by using a female work-life expectancy table. Okay. All right, so here we have a work-life expectancy table. This is for an initially active woman with a GED. Okay, so not a high school graduate, but got her equivalency degree. And you'll notice she starts out in the workforce at age 18, and we've got the mean, the median, and the mode. Okay, the mean is going to be the average. The median is going to be that half of women are above this, and half of women are below this figure. So it's just the middle number, and the mode is the most common number of years that this person would be in the workforce. So generally speaking, we're looking at about 28 more years of working life. Okay. Then as we're going across, you'll see the 10%, the 25%, the 75%, and the 90%. These are percentiles. Okay, and so the number under 10%, which is 15.5, that's going to be the bottom 10%, are expected to only have a work-life expectancy of about 15 years. Under the 90th percentile, that means that 90% of the people studied are below this. The top 10% are expected to work 40 years. So this will give you a chance to look at the probability of somebody. Let's say we have a case and the plaintiff claims that she's 18 and she claims she's going to work straight till 50 with no time out of the workforce. Well, we would say, okay, that is possible, but is it probable? Because only 10% of 18-year-old women with a GED are going to work that long. Okay, and that's if you have a work-life expectancy that's being claimed on, and you're on the other side of the case and you don't think it's particularly plausible, that's a way to obtain a measure of just how improbable such a claim is. Okay. This is, by contrast, to show you the effect of educational attainment on work-life expectancy. This is for an initially active woman with a professional or doctoral degree. Notice she enters into the workforce a little bit later at age 26 after she's finished her schooling, but much longer work-life expectancy, about 38 years as opposed to 28, so about a 10-year difference there. Okay, and then if we're looking at the top 10% under the 90th percentile at age 26, the top 10% work an additional 48 years. Okay, so that's demonstrative of the fact that the more highly educated the plaintiff, the longer they're probably going to work, and that's usually a function of the fact that they have sedentary jobs that don't require physical activity, so they can work longer and work when they're elderly. And then the jobs tend to be more stable, more remunerative, and so forth. So people just tend to spend, and they've also spent a longer time preparing for them, which would suggest that they're interested in working. So again, work-life expectancy is going to be highly dependent on the educational attainment of the plaintiff. And as I said, work-life expectancy is always sort of a game of survival. So even if we look at this, this is for the professional again, professional woman at age 60 still has on average about 6 more years, okay? And then the top 10% would work 12 more years to age 72. Okay. And then this is, okay, and that was for the GED. So even with a lower educational level, if somebody has worked to age 60, they've got a high probability of working to 65. Here for a professional at age 60, we've got sort of a median of 9 or 10 more years to age 70, okay, if they're still working at age 60, and then the top 10% go on to work for another 16 years, okay, to age 76. All right, okay, so as with life expectancy, the longer a worker works, the longer they're expected to work. And if you've got a 65 or 70-year-old plaintiff, if they're still working, they're still going to have a work-life expectancy. Okay, healthy life expectancy is a little bit different. Healthy life expectancy takes data on life expectancy, but also looks at the healthiness of people at every age to determine how long they'd be able to carry out sort of the normal activities of daily living. These are people who feel like they can still do everything, and sometimes for older plaintiffs who have sort of surpassed their work-life expectancy, healthy life expectancy, if they really want to work, might be used as a measure of how much longer they can work. Okay. All right, so here at age 0, we've got our cohort again of 100,000, and I'm looking at the figure of E, H of X. So somebody at age 0 probably is going to have a healthy life expectancy to about age 68, while they're going to have a life expectancy to about age 81. So usually you're not going to be able to do everything until the end of your life expectancy. You're going to sort of cut off a lot of activities shortly before you die. Okay, but here's an 80-year-old, okay, and this individual, people age 80 still have a life expectancy of about 9.76, about 10 more years, and a healthy life expectancy of about 6 more years. Okay, now I'm going to move on to looking at measuring earnings, okay, earning history, earning capacity, and self-employed workers. So when a plaintiff is injured and prevented from earning income, one of the first questions that the damages expert is how much income, but for the injury, would they have earned? Okay. And usually for established workers, somebody who was in a job, had been in the job for a while, was expected to remain in that job, we would look at their past W-2s or the historical earnings, maybe take a look if they were going to be promoted, what kinds of wage increases they would receive, and we would rely on that. Okay, so those are appropriate for plaintiffs with established jobs with predictable earnings. Some people's non-salaried workers can be a little bit different. People whose hours would be expected to vary, for instance, union workers or construction workers, they may have annual earnings that differ depending upon the availability of work. For construction workers, sometimes it will depend on the weather. Sometimes it will depend on the economy. For instance, a lot of construction workers during the Great Recession, because there was no construction going on, got thrown out of work. And so we would expect over those years their hours of work went down, and then when the economy rebounded, went back up again. So sometimes for people who work hourly, you may want to go back farther, maybe 5 or 10 years, to see how their hours vary from year to year, and take an average of those and then multiply it by their wage rate. Okay. The other thing that you can do for those is sometimes the union will just have average hours for people in that trade, and you can rely on that as well. Okay. And then frequently there are plaintiffs who have an intermittent or sporadic earnings history. Either they don't remember where they worked, or it's hard to subpoena every employer they worked for the past 20 years and so forth. And so for these people, I usually try to request a Social Security earnings history. And this is something that the plaintiff can go out, they can even go online right now and obtain, or they can go down to the Social Security office and receive it, or if you want an itemized Social Security statement of earnings, and that's going to give you their entire earning history ever since they entered the workforce, and it's going to give you the names of their employers. You can request an itemized statement of earnings, but for that you have to go online and have the plaintiff sign off on this form, and then Social Security will send it to you. But those are useful tools if you're having a difficult time getting pay stubs or W-2s or tax returns from your plaintiff, or you feel that the plaintiff is sort of sporadic in the past, expected to be sporadic in the future, may have multiple years with no earnings at all, and you want to demonstrate that. The Social Security statement of earnings is very helpful for those kinds of plaintiffs. Okay, and sometimes in the past, Social Security will even mail it to you, and it'll look like that. Okay. For self-employed workers, people who are sole proprietors, maybe they have a small mom and pop business, we're going to want to look for their Schedule Cs. That's a profit or loss for business, and usually we'll be looking at the net income from the business. And a lot of people, sometimes this results then in sort of reduced earnings because this is something that's produced for taxes, and obviously people want to minimize their taxes, so they may minimize their self-employment income. If the plaintiff doesn't want to produce their tax returns, in some states you don't have to do that. You may want then just to, they don't have to produce the entire 1040, just the Schedule Cs and all the attachments, so we'll just isolate the self-employment earnings. Self-employed workers may not turn up on Social Security earnings histories unless they paid into Social Security or if they were paid under the table. So Social Security statement of earnings that I was talking about before are only going to reflect those earnings of people who paid into Social Security or employers who paid into Social Security. If they were paid under the table or if they were self-employed and didn't pay into Social Security, those earnings are not going to show up. Okay. Sometimes plaintiffs will claim a loss of earning capacity. This might be if they weren't working at the time of the injury, or if they didn't earn a lot, they may say, well, no, I wasn't in the workforce and I wasn't necessarily earning a lot of money per year, but I had the capacity to do that, and injury has destroyed my capacity to do this. And this often tends to be a battle between plaintiff and defendant, where the defendant will hold out the actual earnings record and say, you know, you're claiming your earning capacity is $50,000 a year, but you never made more than $40,000. And the argument against that is, of course, and now I never will because you've destroyed my capacity to do so. And that the jury will sort of sort that out and make a determination. Okay. So for earnings increases, usually you want to look back and see a consistent pattern of earnings increases, or if wage increases for union workers and so forth are governed by a bargaining contract, and the contract goes out 5 years into the future, and every July 1st somebody gets a 3% increase, those you can include those increases and they really can't be disputed because there it is. All right. Generally speaking, this was the question about promotion earlier. Promotions to higher paying positions or significant future wage increases. You do want to introduce evidence of that rather than just speculating that somebody who got, came into an entry-level job was eventually going to be chief executive officer of the company. You want it to be realistic and not be dismissed as speculative. Okay. We talked about self-employed workers. Okay. And self-employed workers who go on and continue to work, sometimes you can show a marked loss of earnings if you have the Schedule Cs after the injury occurred, and you can measure the difference between what they were earning prior to the injury and what they were earning after the injury, and the delta is going to be their loss. Okay. All right. Self-employed workers, if they're completely incapacitated, often they are asked by the defense why they didn't hire labor to replace them, or be told that they should have hired someone to replace their services, and they haven't really lost all of their income. They've only lost what it would take to hire someone to work when they cannot. So you want to be prepared for that possible counter. And the earning capacity of self-employed workers also may be measured based on not what they actually earned in self-employment, but what they could have received if they had gone out and hired themselves out as an employee. Totally disabled workers who can't work and cannot continue to earn may be asked why they didn't attempt to sell their business to mitigate their loss. Okay, questions? All right.
Okay, if everyone can type in the passcode into the Q&A widget, that'd be perfect. Thank you. Nora, I did send you some questions.
Yeah. Okay, I've got one here. Can you discuss the hedonic damages claim and how to avoid duplication of damages? This is a good question. Hedonic damages have nothing to do with what I'm talking about right now. Hedonic damages are available in a couple of states. I think principally now Nevada, I think sometimes in Arizona. And what it is it's a damage that's a measure of sort of the value of life itself. It's sometimes misconstrued as, because of the word hedonic, which is synonymous with hedonism, the enjoyment of life, but it really isn't that. It's about measuring what is human life worth in dollar terms, period. And there are experts, I think Stan Smith is one of them, Robert Johnson is another one, who say it's worth about $5 million. And then if somebody has, is still living but has lost some aspect of the quality of their life, they take a fraction of that and apply that each year to measure it. There are people in the forensic economic community who vigorously argue against it, and there are people in the economic community that vigorously argue for it. When it's taken out of the states that, when the claims are raised in states that don't necessarily honor it, for instance, California, it's frequently just struck down. If you want me to go into an extended digression about what hedonic damages are, I'll be happy to do that, but it would take more time than I have right now. Okay, take this one. Is the statement of earnings gross earnings or net earnings before deductions? I think that refers to the Social Security statement of earnings, and usually what I look at is Medicare earnings, which would be gross earnings before deductions for things like contributions to 401k and so forth. On the W-2, when you look at the wages column, it will include tax deductible items. So I always, if I'm looking at a W-2 or I'm looking at a Social Security statement of earnings, I'm generally looking at Medicare, which will reflect the gross earnings. Okay, do the tables take into account standard deviations? If so, how are they reflected? Yes, the tables will have standard error and other statistical measures in them, and you can allude to those, but as a practical matter, I've never really seen that come up. Okay. Is self-employed earning capacity based on the gross or the net? Generally, it is based, it's not based on gross revenues of the business because that's all the money that the business took in before expenses. But it's generally based on the net income of the business. Sometimes if the business has continued to go on, you would just deduct their variable expenses because if the business continued, they were still paying their fixed expenses even though they had a reduced income. Okay. Do we have reliable mortality tables which include other variables other than current age and gender, such as race, ethnicity, medical history, exposure to toxic substances? We have life tables that are based on race and gender. So we have male, female, white, black, Hispanic, and Asian. In terms of medical history or exposure to toxic substances, then you're getting into sort of subsets of tables and cohorts of people with certain medical conditions, and generally you would either have to go to, there are some experts that will look through an individual's medical records and calculate a life expectancy for them, or you'd have to go to a medical expert or treating physician and get a prognosis for that specific person. Okay. All right, in wrongful death case, how is the joint life expectancy of decedent and spouse applied to loss support services? Sometimes the joint life expectancy, which means that you multiply the life expectancy of the decedent and the life expectancy of the spouse to determine how long they would have sort of survived together. And yes, this is done, but not always. Generally, what it will do is reduce the loss a little bit. And who provides life expectancy data? That is the Center of Disease Control, U.S. Vital Statistics, and it's put out by a statistician. I assume that it's statistically valid and so forth, but one thing that you have to remember about it is we can only determine the life expectancy of up to this point in time. In other words, life expectancy tables that I'm relying on now, the most recent ones, only have data up through 2017. So, and we're using them to project the life expectancy of people who are going to be living in the future, which we don't really know yet. So there is, I suppose, that difficulty with using them is that we really don't have a life expectancy table that predicts the future. We can only say what life expectancy has been in the recent past. Okay, I'm going to move on, but we will have more time for questions. Okay. All right. And now, Nadja, I can't see my screen anymore. So I'm going to.
You want to refresh your screen?
Sure. I don't know how to do that. Now I have a completely blank screen. What I'm going to do is log in again. Sorry about this.
Okay.
Okay. Okay. So now I'm going to talked about earnings. Now I'm going to talk a little bit about fringe benefits because this is something that can add quite a bit of value to the loss. And if you're doing a rough calculation, say on the back of a cocktail napkin about how much your plaintiff lost and not counting in fringe benefits, you may be leaving quite a bit of money on the table. So this picture right here is of a W-2. And you'll notice that we have all these little boxes, and we have some boxes that will give us some information about the value of this individual's fringe benefits. Okay, one of the fringe benefits that tends to be worth the most money is employer contributions to medical insurance. And if you have the plaintiff's pay stubs and you have the W-2s, you can figure out what the employer contribution is on your own. Okay, so if we look at here and we see this over here, this box over here with the C, the D, and the DD, and the DD says $25,632, that is the value of the employer and the employees, I'm going to emphasize that, contribution to health insurance. So usually when you get health insurance as a benefit, your employer pays part of the cost of the premiums and you pay part of the cost of the premiums. And what you want to tease out is what the employer paid, because that's the value of the benefit from the employer that you lost. So if you also have their pay stubs, you see here before tax deductions, that would be what the employee paid, and you have over here employer paid benefits, and that's what the employer paid into it. So if you look over here and you see that you've got this employer contribution to medical benefits, the $1,677, that's what that employer paid per month towards medical benefits. And so that benefit was worth if we take the $1,677, multiply it by 12 months, okay, total value of that benefit was $20,124. That's going to be less than what's reflected on the W-2 because the other $6,000 is what the employee paid into it. That was deducted from their wages. Okay, but you can get back to it if you have a pay stub and you look at what the employer was paying in the medical benefits and figure out what the plaintiff's medical benefits were worth. Okay. And Nigel, let me ask you, we've got about 6 more minutes. We've sort of gone on longer than I expected to. Do you want me to end at the 60-minute mark, or do you want to go on a little bit, or what do you want to do?
Just for the sake of everyone else's time, yes, let's end at the 60-minute mark, and any questions that we do get in, as we discussed, I will email them to you. And, you know, they do get the presentation as a PDF format as well.
Okay, so I'm not gonna go. I think the rest of the slides are actually pretty self-explanatory. So what I'm gonna do is I'm just gonna go right to the end and answer questions. Go. Okay. Okay. I'm going to go to practice pointers because I think this is helpful. All right. If you think that you're going to need an economist for a case, okay, it is always best to plan ahead and retain an expert early on in the case. That doesn't mean some experts will charge a retention fee, some of them won't. Okay, so I would find somebody who doesn't, and then it'll probably only cost an hour's worth of time. You know, send them the complaint, send them the plaintiff's responses to form interrogatories so they have some background about the case, and ask them for a list of the data that they're going to need for an analysis, and then assiduously collect that data and put it aside. Okay, if you don't want to pay for an economist, you know, to go in and settle, mediate the case, you won't need to do that. Okay, but if you don't settle, you'll have everything that's ready to go, and it's going to send you a lot of time in billing. A lot of times I have to add more hours to an analysis than that's unnecessary, because I have to go back and ask for more data or research or look for something on my own, and that's just time that isn't really usefully spent. So if you plan ahead and you get a data list from your expert and you have all that data collected, it's there when you need it. Okay. Sometimes it's helpful to have a preliminary. A lot of my work is producing preliminary reports for settlement purposes, for mediation or settlement, and it will do two things. Sometimes that has more credibility than asking for a number. If you're using an expert who, you know, is not known to engage in puffery or inflating damages, it may be helpful to settling the case so that both sides understand that they have a reliable number for what the economic damages are in the car. Working out a budget with your economist beforehand always ensures that there's no surprises on either side. Generally speaking, I would have to say, as an economist, I don't like giving people a high bill, even, you know, when it's really warranted. I usually end up billing people less than the time that I spent, but it's always helpful that everybody's on the same page when it comes to the invoice, because that's where a lot of misunderstandings occur. I would be wary of experts who tell you what you want to hear, whether you think they're minimizing the damages or they're maximizing the damages. It's best that the expert tell you what they think is the most credible number and how it is likely to be attacked by the other side. Then you can make a sort of realistic assessment of the strength of your damages case. This is something that happens more frequently than it should, is that usually most of the time I spend with the client is just getting to the report. And very few clients will go through deposition or trial testimony and practice beforehand, but that's the most crucial time because that's when the finder of fact is really making a decision about a number. So it's always good. Of course, things get very hairy right before you're going, you know, into a deposition or going into a trial, but that's really when the time spent with your expert eliciting the answers, preparing for cross-examination really counts. Do not be afraid of math or numbers. Okay, if you don't know, say so. Certainly with your retaining expert, you can be frank about your ignorance. And if you're deposing the opposing expert, you are in control of that deposition. If there's something you don't understand, go ahead and ask and make them explain it to your satisfaction. That's their job. Okay, and I've got 8 more seconds. So what I'll say is this. I'm going to go to my next slide. My email address is right there. You can find my phone number online. I will answer the questions that have been typed into the Q&A session because Naja will send those to me. And if you separately email me a question, I will answer each and every one. It might take me a week or two because I'm busy and some of the questions are complicated. I do apologize that we had to rush through this. I had actually prepared slides for an hour and a half, but here we are. Thank you for attending, and it's been a pleasure doing this webinar with you.
Thank you, Nora. Please remember that if you were applying for credit, you must have attended for the full 60 minutes of the presentation. You're also required to complete the survey that will pop up on your screen at the end of this program. I want to take this opportunity to thank everyone for attending, and most especially Nora Ostrofe for her time and effort in creating this presentation. If you would like to speak with Nora, or if you would like to speak with a TASA representative, of course, you saw the slide with Nora's contact information, and you could also just ask TASA, you know, how to get in touch with Nora. Or you can contact TASA at 1-800-523-2319. One of my colleagues will be following up with you regarding your feedback on today's presentation. This concludes our program for today. Thank you.